Hey everyone, Fibonacci retracement levels are a key tool in technical analysis, helping to identify possible zones of supply and demand ahead of strong price movements in trending markets. That said, they work best when combined with other analysis methods to support smarter trade decisions. In today's video, we're going to break down the correct way to apply Fibonacci retracement levels to better grasp price behavior and enhance your trading strategy. We'll walk you through a step-by-step guide covering two powerful entry techniques, one for trend continuation and the other for reversals, all based on retracement zones. So if that sounds valuable to you, go ahead and tap the like button to support the channel, and don't forget to subscribe if you're new around here. Catch you after the intro. Let's begin by covering some foundational ideas about market structure. No matter if you're trading forex, crypto, stocks, or any other asset class, you'll observe that prices typically move in a series of impulses followed by corrections. This repeating, fractal-like behavior in the market stems from how traders react over time. When market sentiment turns bullish and traders feel confident about a particular currency pair, buying pressure increases, causing a strong upward move. But as the price climbs, some participants might view the asset as overpriced and start locking in profits. At the same time, others may enter short positions, which often results in a pullback or a retracement. Conversely, when market sentiment is negative and traders lack confidence in a currency pair, selling pressure builds, resulting in a strong downward impulse. As the price declines, certain traders may begin to believe the asset is oversold and choose to re-enter long positions, which can once again initiate a retracement. Impulse waves typically drive the price further with strong momentum, often marked by consecutive candles of the same color and large bodies. In contrast, retracement phases reflect market hesitation, shown by mixed-colored candles with smaller bodies and sideways wicks on the chart. Spotting where a retracement ends and a new impulse begins can be extremely rewarding, as it opens the door to potential entry points for buying or selling. This is where Fibonacci retracement levels become a powerful tool. These levels are a series of horizontal markers drawn on a price chart to highlight zones of interest within a trending market. Key retracement levels include 38.2%, 50%, 61.8%, and 78.6%, which often serve as potential trade setup zones. Now let's walk through how to apply retracement levels on your chart. Picture an uptrend made up of a sequence of impulsive surges followed by corrections. We've pinpointed the latest impulse move and are now anticipating a pullback to enter a long position at a more favorable price. To begin, select the Fibonacci retracement tool. Click at the base of the impulse wave, starting from the bottom wick, and drag it to the top of the move. Once placed, the retracement levels will appear to the right. As price retraces to these zones, they may act as support and potentially push the price higher. However, here's a key reminder: pullbacks can vary widely in structure and depth. There are two main types of pullbacks, shallow and deep. A shallow pullback typically signals a strong, healthy trend and usually occurs between the 38.2% and 50% retracement levels. In contrast, a deep pullback tends to happen between the 50% level and a previous support zone, indicating potential weakness within the ongoing trend. Now, this brings us to an important question: which retracement levels offer the best chances for high-probability trade setups? To address this question, we break the potential pullback zone into two sections. In a bullish context, the area above the 50% retracement is referred to as the premium zone, while the area below it is known as the discount zone. Attempting to buy in the premium area may result in frequent losses, as the market often targets early buyers to tap into liquidity. On the flip side, aiming to enter in the discounted area can cause you to miss trades during a strong trend, but when executed well, it offers high risk to reward potential. The same logic holds true for bearish setups. These are some essential principles surrounding price action and retracement zones. Now let's shift into the advanced section, where we'll demonstrate how to use Fibonacci levels to create entry signals. But before diving in, as always, hit that like button to support the content and drop your thoughts in the comments. Typically, we pair Fibonacci retracements with price action using two main methods. The first is trend continuation setups, and the second is reversal-based strategies. Let's kick things off with the first approach, trend continuation setups using Fibonacci retracement levels. This strategy revolves around the 78.6% Fibonacci retracement level and is especially effective with assets that experience deeper pullbacks, such as gold. As a trend continuation technique, it's best applied when the prevailing trend is clearly visible. Imagine a market in an uptrend, consistently forming higher highs and higher lows. The latest impulsive wave begins at point A and completes at point B, and we're anticipating a retracement to secure a long position at a more favorable entry. Here's a key insight: since we're in an uptrend, it's more likely for the price to revisit point B before breaking below point A and reversing the overall trend. To enter the trade, draw your Fibonacci retracement from point A to point B and place a buy order exactly at the 78.6% mark. Set your stop loss a few pips below point A, and aim for point B as your take profit. This setup typically yields a risk-to-reward ratio close to 1 to 3. Now, let's break down each step of this method on a live chart. Looking at the 1-hour time frame on gold, we can clearly observe a strong downtrend with a sequence of impulsive drops followed by minor retracements. We identify the most recent price swing and apply the Fibonacci retracement tool from the beginning to the end of that move, setting our buy limit order right at the 78.6% retracement level. If the price pulls back deeply enough to tap into liquidity, it offers us a high probability entry point. Given the 1 to 3 risk-to-reward ratio of this setup, one successful trade has the potential to cover the losses from 3 failed ones. However, there are 2 important elements you should consider in order to refine your entry accuracy with this strategy. The first factor is the spread. Price tends to respond to the 78.6 level with minimal margin, sometimes within a single pip. So to ensure your order gets filled, either place it a few pips above the 78.6 mark accounting for the spread, or opt for a broker that offers low spreads, like we do. The second factor is the overall market structure on a higher time frame. Before executing any position, always evaluate where the price is coming from and how much potential room it has left to move before encountering a major demand or supply zone. Take gold as an example again. When we shift to the 4-hour time frame, we notice that a major demand zone lies ahead of the current price action, with significant space still remaining before it's reached. This scenario supports the logic for opening short trades. However, if price had already interacted with that higher timeframe demand area, it wouldn't be wise to short without further confirmation, because the market could easily reverse from there and invalidate lower timeframe supply zones. Hopefully, that explanation makes sense, but if anything still seems unclear, then let's walk through another bullish scenario. On the 1-hour time frame, the market is clearly in an uptrend. This marks our most recent impulsive leg, and as long as price holds above the identified swing low, the uptrend remains intact. So, if the price retraces down into the discounted zone, it could present a solid opportunity to enter a long trade. Now let's move up to the higher time frame to get broader context. On the 4-hour chart, we can see that price has recently broken above a significant supply level, indicating that demand has taken control. Plus, there's still considerable distance before the next resistance zone, confirming that both higher and lower time frames are aligned in a bullish trend. So, we'll draw our Fibonacci retracement tool and set the long entry at the 78.6 level, placing the stop just a few pips beneath the swing low. Choosing your profit target is flexible, but aiming for the close of the lowest candle is a reliable way to lock in gains. Let's continue with the next segment of this video. Now let's dive into the reversal trading setup using Fibonacci retracement levels. But before we do, drop a comment below and let us know which topics you'd like to see covered in upcoming videos. We always review your suggestions to guide our next content. Reversal setups can be a bit complex since they involve trading against the prevailing trend. However, the upside is that they offer a potential for high risk-to-reward ratios. The setup we're about to explain blends 3 core elements: a significant structure level, a double top or double bottom formation, and key Fibonacci retracement levels. Let's begin with the concept of a major level of structure. When a zone has been rejected several times, serving both as support and resistance, and is still being respected recently, we refer to it as a major structure level. These levels often offer high-precision trade opportunities. This confluence increases the chances of a price bounce from the area, making it an ideal condition for setting up strong trade entries. A double top or bottom is a well-known M-shaped reversal pattern commonly used by price action traders. But keep in mind, we follow a specific rule to validate a double top or bottom setup. For a double top, draw a rectangle from the highest candle close to the wick of the initial test. Then, ensure the wick of the second test at least touches this zone, while the candle body must not close above it. Now, let me walk you through the step-by-step process of setting up a reversal trading strategy. This setup involves using two time frames. On the higher time frame, we assess the overall market direction and structure, and we identify a major level of structure that has the potential to reject the price. Let's take this as our higher time frame, where we analyze the overall market structure and identify the dominant trend. From this perspective, we observe that the market had been in a clear downtrend until it reached a critical price level. At this point, the market failed to create a new lower low, which indicates a potential loss of bearish momentum. Shortly after, the price broke above a significant supply zone, suggesting that demand has now taken control. We can also identify a major structure level that has recently acted as both support and resistance. Since this level has been respected multiple times, it increases the probability of another potential rejection if the market revisits it. Additionally, there's plenty of room for the price to rise before hitting the next supply zone, which gives this setup a favorable risk-to-reward profile. Our next move is to patiently wait for the price to revisit this key structure level for a possible long entry. Then, we zoom into a lower time frame to time our trade execution with precision. On this lower time frame, we look for a valid double bottom pattern to signal a potential reversal. Once the price successfully breaks the neckline, confirming the double bottom formation, we move to the next step. We apply the Fibonacci retracement tool from the beginning of the impulsive move, from the low of the double bottom, to the end of the breakout. We then place our buying order precisely at the 61.8% retracement level, a key Fibonacci confluence zone known for offering high probability trade entries. Our stop loss should be positioned just below the swing low to protect our capital in case the setup fails. As for the target, you can aim for the recent high or extend further to the next major resistance level, depending on your risk appetite and overall market context. This approach allows you to combine structure, patterns, and Fibonacci for a high-quality reversal setup. Now let's analyze the next level of market structure on the higher time frame. On the gold 4-hour chart, we've recently seen a clean break above a key supply zone. This confirms that demand is currently in control. If the market pulls back to this broken structure level, it presents a strong opportunity to look for long trades. Why? Because this area now acts as a major level of structure, previous resistance turned into potential support, and it's likely to reject the price. At this point, all we need to do is remain patient and wait for the price to tap into this demand zone. Once it does, we'll shift to a lower time frame and look for confirmation signals, such as price action patterns or Fibonacci retracement entries, to execute the trade with precision and confidence. Here on the 1-hour chart, we can see the market structure in much more detail. As price taps into our higher time frame demand zone, we notice a strong triple bottom formation, clearly rejecting that level. Once the neckline is broken, we get confirmation of a potential reversal. However, entering the market immediately would require a stop loss that's too wide, reducing our risk to reward efficiency. So instead, we wait for a pullback to enter at a better price. Apply your Fibonacci retracement tool from the bottom of the move to the neckline breakout and place your buy limit at the 0.618 level. Set your stop loss just below the swing low. Here's the trade management plan. Once the price reaches 2 times your risk, close half of your position to lock in profit and move your stop to break even. Then, let the remaining position ride until the market hits the next key supply level on the higher time frame. And that's a wrap for this video. If you found value in this breakdown, make sure to like, comment, and share. Drop your questions or next topic suggestions below. We always look at your feedback to decide what content to bring next. I hope you found real value in this session. If you did, make sure to smash that like button to show your support. It helps more than you know. Drop your thoughts in the comments, and I'll catch you in the next episode. Until then, stay sharp and trade smart.